funds creates more opportunity for active return. The more money that blindly buys the largest companies in the market means that the mid-sized companies and those below them get neglected. Because that's where the money is going, into the big companies. The other companies are under-researched, they're under-owned, and they're providing you access to parts of the economy which the big companies can't get you. If you look at one of the big things in this region, consumption. If you look at consumption trends in China, how do you get exposure to consumption in China? It's very difficult. Everybody's buying the department stores. They're on 30 times multiples. They may go to 50 times in terms of multiples, but they're going to become more expensive. So what other companies are there out there that are going to give you access to that thing? There are mid-sized companies, distribution companies, companies that only have one product or one line of business, which are definitely exposed to the consumption thing, which the index funds are not buying. If I look at a typical sovereign wealth fund portfolio or a big institution, a US endowment fund, that buys an emerging markets fund and invests in China, typically it has about 3% invested in China. Within that 3%, it maybe holds 5 companies. I know without even looking in their portfolio what those 5 companies are. And they're the companies that have done well in the past. The reason why they're big is because they've been successful. But the next 10 years, in terms of development, the next champions in that market are not going to be the companies that did well in the past. They're going to be the new companies which are coming to the market, which are going to do well in the future. And that's what these index managers will not pick up. So although it's a challenge to us commercially, I think what you're going to see is greater differential performance in terms of active and passive. So active returns, particularly in the emerging world, are going to continue to develop. I'm being given a signal to speed up a little bit. Maybe I can just talk a little about distribution patterns. I think what I'm showing here is different countries have different distribution channels. Going across the top, you've got retail banks, private banks, insurance, IFAs, fund supermarkets, direct fund of funds, institutional and others. This is distribution channels in Europe. And you can see even in Europe there are vast differences in the way people buy their funds. And that affects the buying behaviour. Because how you buy your fund, to a large extent, defines what you buy. So if you buy your funds through a discount brokerage, you're much more likely to buy an ETF than you are if you buy your fund through an IFA. Because it's an instant substitution. So we really have to understand the distribution trends. I think interestingly, in the UK, about half the market is distributed through IFAs. What I would suggest is that as a result of the crisis and as a result of the need to continue to provide better advice and build confidence, I think we're going to see more advice being offered by the large institutions, the banks and the private banks. And I think a gap is opening up in the market where, in order to trust the company you're working for, the company you're working with, when the client comes along, needs to trust the institution. At the end of the day, they need to trust the individual who's sitting across the table from them, who's sitting across the desk. I think what we're going to see is greater levels of professionalism amongst IFAs, and I think we're going to see the IFA channel develop globally more significantly. Now in the US, the market's split pretty much 50-50. There are people who just don't want advice. They think they can provide them advice themselves. And the US is the ultimate market of choice. If you don't want the advice, you don't pay for it. You buy no-load funds and you get zero advice. So you have the choice. And about half the market goes no-load, no advice, and about half the market goes load with advice. There was some statistical analysis on this, which looked at which part of the market had the best performance. And I think statistically it was inconclusive. But I think that's the wrong question. The question is, what do people want? Coming back to what I said at the beginning, it's about your clients having the confidence to take the responsibility to make a decision. So whether you get that confidence by going online watching CNBC, or whether you get that confidence by paying for advice. The critical aspect is that your investors, your clients, feel confident in owning the decision that they make. So when your clients ask you, what is the right investment for me? I'll say it again, when people ask me that question, I say that's not a question I can answer. You have to answer that yourself. What I can do is help you. Ask the right questions so that you identify your objectives, that you understand your issues, and that you make good decisions that you're comfortable with. Let me scroll forward perhaps then to wrap it up at this point and leave some time for questions. I put some slides in here also on the investment environment. I think just a couple of comments on the investment environment. There's no doubt that we're living in a period now of great uncertainty. We're seeing a rebalancing of the global economy, and it's a rebalancing which is taking place in a remarkably short period of time. If you look back over the last 10 years, all of us in this industry, we know what we faced, from the Asian financial crisis to the technology bubble burst, to the difficulties that we faced during the financial crisis globally. These are unprecedented crises to have occurred in such a short period of time. You have to look back to the 1920s and the 1930s for another period of such cataclysmic proportions. This makes our job clearly more difficult. And that leads me to what our industry needs to do, and I think, as I say, many of these points are covered very well by your president at the outset. And I think number one is to set the agenda. We need to be vocal in our communities. We need to get our point of view across. We need to get our message across. We need to be active in the press. We need to be visible in our communities. We need to understand what the key issues are. We need to look forward, not look back. We need to look at what's occurring, what's likely to occur, and anticipate changes. And that's our job, is to help set expectations. So if we get a big allocation of money to this region, and if our equity markets go up, and if inflation picks up, what does that mean for your clients? That's from an investment standpoint. And they're questions we should be already putting on the table. In terms of retirement planning, if in Malaysia your government is successful in implementing a private sector scheme, what does that mean for your clients? What are the issues they're going to face? What do they need to understand those issues? That's your job, because I can tell you from our experience in Hong Kong, the public were terribly prepared, and they viewed a compulsory private sector pension scheme as just another tax. A tax that if they could, they would avoid. We even had politicians during various crises in the last 10 years suggesting that we stop making contributions to our retirement scheme during difficult times because people were finding it tough in order to cope with the crisis. Which is exactly the wrong thing to do. Exactly the wrong thing to do. The whole point of retirement saving is that you keep it going even when times are tough. So, setting the agenda. Number two, align with your client. I know we all do. We talk about our industry. You've got to get that vocabulary, the volume needs to be turned down. You need to talk about your clients. If you represent your clients, you represent your industry. Talk about what your clients are thinking, what they're facing, their challenges, what they need. Represent your clients and your industry moves up 3-4 steps in terms of how people think about us and the importance that we have in our communities. Promote long-term saving. That's hard to say from an Asian standpoint. I think one characteristic people think is uniquely Asian is trading. We have a trading mentality in this part of the world. I've been living here 21 years. I don't look like an Asian, but I certainly behave like an Asian when it comes to investing. I like to take profits. I think it's a good discipline in investment management, taking profits. Our fund managers every day of the week take profits in their portfolio. There's nothing wrong with taking profits. The reason why many investors don't take profits in Europe and the United States is because of their tax systems. The tax systems discourage them from taking profits because they have capital gains tax that they have to offset. So they tend to turn over their portfolios less frequently. The structure of their markets is different. They have a different appetite for income, which perhaps we're going to develop as we get older. So the circumstances are different. So there's nothing wrong with a trading mentality. But you have to put that in context of building long-term savings. And this is what individuals need to understand. That sometimes for a part of their portfolio, you need to put aside money that is going to accumulate over a longer period of time. And that's an education, and that takes time. You need to demonstrate that. You need to explain it to your clients so they start to think longer term. And quite honestly, the financial crisis is an opportunity for the unit trust industry. Because what was shown to misfunction, to malfunction through the crisis was any financial product which was not transparent failed. It failed in not matching expectations because when things went wrong, nobody understood what the product was doing. Whether it was a hedge fund, an alternative investment fund, or whether it was a structured note or structured deposit. When the markets got difficult and prices came down, individuals panicked, they didn't understand what was going on. That's not the case with mutual funds, within unit trusts. Our product is transparent. So if you think about it, as we come out of the crisis, as we reinvigorate the enthusiasm for unit trust investing, one of the key things we've got, which no other product has, is that we are totally transparent. You know every day what the price of the product is. You know how it's invested. You know what the charges are. You know who's responsible for managing the product. There's a name on the fund, or a team, or a company on the fund. These are the attributes we need to promote. Because in long-term investing, there is nothing that competes with a unit trust, which allows money to go in and out regularly. There is nothing that competes with a unit trust. The next point I want to talk about is support multiple distribution channels. We should think about our clients overall and accept they are going to be accessing financial products through their bank, through their IFA, through their stockbroker, through their advisor. And I think we should support that. We should look to raise the professionalism of all parts of the financial services industry. This is not a win-lose situation. This has to be a win-win. If the banks fail, if the private banks do a bad job, that reflects on us. We're in the same business. We're in the same industry. And I think from a company point of view, those of us involved in managing companies, we have to improve the efficiencies in our business. We have to get economies of scale. We have to get the operating expenses down. We have to give value for money for our client. And with that, I'll finish up. I'll thank you again for
insightful presentation. Now, ladies and gentlemen, in view of time constraint, Mark, please remain on stage. Yes. Oh, yes. In view of time constraint, we can allow just 2 questions for this session. Question number 1, maybe you can.
If you're only allowed to, make sure they're very.
Or if you can speak loud enough, probably we can repeat your question. Yes.
Konyn, thank you for your time. Given your regional expertise, bearing in mind what our president said about the fact that our front-end commissions in Asia, which are historically lower than they used to be, but I think regionally relatively high. If you look at the various distribution channels, our front-end commissions run between 2 and maybe 7 or 8%. Our management expense ratios in various asset classes run 0.5 to 1.5. Based on your regional perspective, where do you sit and where do you see the trends running down to?
So the question is basically, based on regional trends, where do you see what numbers running?
Front end.
The front end loads.
And management fee.
And management fee, where are they going?